Now, some of our recent content, questions that were asked and original content that was posted this week, optionable stock statistics, the market sentiment tool, and more. Discussion on some of the features and power options. ETFs and optionable stocks for tracking Bitcoin and cryptocurrency. That was for Fernando last week. 2 ways to trade a strategy, bull put credit spread, which was from a discussion on a coaching session earlier last week. We did post 11 minutes on our market reaction to the events of September 20th, 2021, the Evergrande consideration and things of that nature. Using the picks of the day and how naked puts perform in a down market. We used some history last week to show during the 10% correction in September of 2020, how the cash secured naked put approach would have gone, would have panned out during that decline. And when to roll or let expire an OTM covered call, and best time to roll as well. So those are some of the recent topics covered. You can check that out on YouTube at any time. Just find Power Options there, go to the video links, or you can use the search feature to search for a specific discussion that you want to see and why. So we're talking now about expected price movement of a now in the money sold put, naked or cash secured put, as we get closer to expiration. I'll paraphrase this slightly, but this came from Salvatore. He says, on a current in-the-money naked put with 21 days to expiration, with the intention of being willing to pay to get out and not getting assigned the underlying shares. Say I took in $1,000 and today's buy to close price, I believe he meant, is $1,300. If the stock price remains unchanged, will the buy to close cost decrease each day until expiry or increase? It will decrease, and we're going to talk about why. I realize there is no way to know, but in theory, if nothing changed with the underlying stock, and the contract was in the money, it would be reasonable to expect the price of the contract buy to close to gradually increase up to the expiration date, and only if the stock is still falling, but potentially not even then. Is there some analytical tools such as the Power Options profit and loss calculator graph that one can use for this type of analysis? So in a nutshell, what are we talking about here? We've got a put that's in the money. How is it going to react over time? What would our expectation be? Well, current example, similar to what he was talking about, 21 days away is the October 15th standard expiration. I did a naked put search using Power Options for something that was slightly in the money and at the same time had a price of around $13. So we came up with the 15th of October, 237.5 strike put for Coinbase, COIN, which is currently trading at 232.58. So we're right about 5 points in the money on this position. We simulated that we sold to open this put on September 20th for $10. But now that the stock has fallen, the current buyback price is around $12.90 or $13. So we're looking at a $3 loss on the position from the premium. So it's 5 points in the money, which means what? Roughly 5 points in the money means we roughly have $8 of extrinsic or time value that is going to decay over time to the 15th of October expiration. This is what we would expect with the time decay curve of an option. What is the one rule, main rule about all options in the market? As you get to expiration, the time value or extrinsic value goes to zero. That is a fact. It's going to go to zero. Okay, maybe it goes to 5 cents the minute before the market closes if you're trying to buy it back and it's still roughly a little bit out of the money. But that's what we expect to see with the time value. That extra amount of time value will decay out of the option. The $5 or the intrinsic value is going to remain. If I'm in this coin put at 237.50 for the 15th of October expiration, and the stock stays right at 232.50, as we get closer to expiration, that $13 price right now is going to drop down to $5. It's only going to have the intrinsic value, the amount that we're in the money, remaining. In this case, the amount that the stock is below our sold put strike price. Now, what about the analysis tools you can use on Power Options? Well, when you were talking about the profit and loss chart, which was showing the graph that we just saw there for the Coinbase naked put position, underneath the profit and loss chart, there's a calculate feature. This calculate feature allows you to put in any price and select the date between now and expiration, and it will show you the change in value. Now, if the stock falls, the buyback cost is going to increase because it's going to be gaining intrinsic, but time value is still going to be decaying out of it. It's just going to be intrinsic value if the stock continues to fall. Now, if the stock rises, we're going to expect the premium to decline, but extrinsic or time value might increase. It sounds strange. We're going to show a perfect example of that. It's what's known as the ATM Bell Curve. So when a stock is trading right at a put strike price, right at the exact strike price that you're in, that put will typically have the highest time value, of all the other options in that expiration cycle. If you look at an option chain, the one that's the strike that's closest to the stock price, call or put, will have the highest time value. But if I wanted to simulate what would happen here if Coinbase dropped to 230 on October 6th, which is halfway between today and October 15th expiration, we see that the price does increase up to $1,100. But what does that tell us? If this was at 230 and we have the 237.5 put, this means that $7.50 of this is intrinsic value of that 1,100. The remaining $3.50 is time value. So it got more in the money and went to a higher price because it gained more intrinsically. Another 2.5 points down, we lost time value. Absolutely, but the price still went up to $1,100. It's not as big a loss as it is now at $1,300. That time decay, Salvatore, worked in our favor, even though the option went more in the money. This isn't a big move. It's only $250, but the price actually decreases by $2 from the buyback cost it is now at $13 because we lost more time on the position and it's now deeper in the money. Another analysis tool that you can use directly from the option chain or linking from the search tools in PowerOptions is to go to calculators and then go to the Black-Scholes. The Black-Scholes calculator will show you the expected decay in price of the option. This is using the values that we have right now with the stock trading at 232.50. What would the expected price change be every day as we get closer to expiration? You see here it ends right at about $5 or so because we're losing that other $8 of time value and we're holding the intrinsic value on the position if the stock stayed the same price. And of course here you can also on the Black-Scholes calculator see the expected price change of the option as you go day by day, keeping the same price. As you can do in that calculate feature on the profit and loss chart, you can also input different stock prices. So if I expected the stock was going to be at 230, say on October 6th, it would show me this new graph of what the price expectation would be and the change each day if the stock was at 230 instead of 232.50. I can evaluate that individually, putting in the number each time. Okay? And part of Salvatore's comment was, we don't know what's going to happen. I understand that if the stock moves up, I'm expected to lose option premium. That option is going to decay. It's not going to be as deep in the money. Or if the stock continues to fall, it's going to be a much higher price in that position. It's going to be much higher in that position because you're gaining more intrinsic value. But let's go ahead and take a look at a somewhat wild ride, keeping the same stock, but going back a few months. On July 9th, 2021, Coin was trading at 253.88 at the close on July 9th. Similar position to what Salvatore was talking about. If we went 21 days out, we could have sold the 30 of July 230 put, which was at 450. And the red line here shows us where the 230 put is. You see it dipped down below 220 and then came back up and then came back down again as we got closer to expiration. At the start of this position, this naked put, cash secured put, was 9.4% out of the money, had a delta of 0.2, and a 77.8% probability above. Yes, I picked this one because it is more volatile, and I picked this time frame because it gives us all of the worlds of going in the money, then coming back to being out of the money, then almost coming at the money again and going in the money, and then ending out of the money for a full profit on this position. So, how did the price react? Well, I used the historical search to isolate the 30th July put on July 9th. I could have also used the historical search by symbol in the backtest tools to just find that position, the 30th July put, 230 put, excuse me, for July 9th. But in these features, it allows me to look at an analyzed position view so I can see the graph of the change in the option price versus the stock price and the change in my return over time, or I can look directly at the price history of the option itself. So going back once more, we're entering, I got to change my pen color. There we go. So we would have entered the position here with our 230 put. And a few days later, we're deep in the money. Then it comes up, comes down again, and then it gaps back up and ends, over here, out of the money for the full profit. How did this option react over that time period? Well, the analyzed position view, it gives you a breakdown of what happened, simplest view in the trade. The max return, 2% on 730. The stock ended at 236. So it expired worthless, and that was the max return. The max loss was on July 19th at 4.5% over this time period. The first graph you see on the analyzed position view from the historical search or historical search by symbol is your return compared to the change in SPX and QQQ. As you can see, the market as a whole was doing some ups and downs. Coin actually recovered better as the market was going down on the 25th, 27th, and 29th. In general, the Coinbase was recovering. But here we see the maximum loss occurred at 719. The maximum loss on the position, that 4.5% loss over time. A better view for what you would want, Salvatore, is over here. This is showing you the second graph in the analyzed field is the option midpoint versus the stock price. So as you expected, as the stock was declining in price, the put option was going up in price. Highest buyback cost at $14.75 was, of course, when the stock was at $220. But 10 points of that was intrinsic value, $4.75 was time value. Why is that interesting? Because look here, when the stock was at 230 here and at 230 here, buyback cost was around 780, 750. That's all time value because it's right at the money. But here the time value was only 475, but it was the highest buyback cost because you had the highest intrinsic value. That was when it was most in the money at that time. But the price history is sort of a better view for these analysis. It's just another feature that we could click on there. And the price history gives us a different view. It illustrates the same values, but with the actual numerics instead of graphically. Naturally, as coin fell after we would have entered the position on July 9th, when the stock was at 253.88, when it started to fall, the price increased a little bit. It fell 6 points between Friday, July 9th and Monday, July 12th. Fell from 253 down to 247. Okay, it was 5.5 points roughly. But the price did decay a little bit in our favor to 435 because we lost 3 days of time premium. And though we're getting closer to what? We're getting closer to at the money. 713, it falls to 243. Price goes to 515. It's increasing. And we're at a loss of 65 cents if we got the 450 midpoint. Right at the money, July 14th, 5 days after entering the trade, we're at 229.94. This is $10.60 of time value and 5 or 6 cents of intrinsic value. We're right at the money. That is the highest time value that we see because the at the money bell curve, and we still have 16 days to go to expiration. Now, on 7/15, it dropped again to 224. The price went up to 13.25. But we're roughly $5.37 in the money, so only $7.88 of that is time value or extrinsic value. The time value is going less of the total value of the put option because it's gaining more intrinsically and we're going deeper in the money, which is on the shallower end of the at the money bell curve. We're moving away from at the money to go deeper in the money. 225, it drops a little bit to 1210, but it's still 709 of time premium. Here's the biggest loss. 719 when the stock was trading at 220.61. So what, we're $9.39 in the money. The price of the put is at $14.75, which means roughly, I'm sorry about that, we're $9.39 in the money. So only about $4.85 or so is the time value. It dropped dramatically from where we were over here when we were close to right at the money. Now we're going deeper in the money. We have the highest buyback cost, but that's mostly extrinsic. I'm sorry, it's mostly intrinsic. I was right the first time, not time value. But then we go forward and we start to drop again. We come back. That was our low. We move up to 224. Let's call it 225. So we're 5 points in the money. The time value is down to 6. It's 11.05 buyback, but $5 of that is essentially intrinsic value. Right again, back to at the money. Where are we? Back to almost the highest time value ranges, not the 1060, which was right at the money 5 days in, but the time value actually went up. Here, time value, extrinsic value. Remember, we're at 11.05, so it's about $6. The stock moved up 6 points roughly, but we're right at the money, and the time value went from $6 to $7.20. Let me clear that up. Time value is essentially always decaying as we get closer to expiration. I'm using the term extrinsic value, which is taking into account the moneyness of where you are on the ATM bell curve plus the time remaining. So the time value was still decaying, but the remainder of what's called extrinsic value, the value that's not in the money, that's not intrinsic, is going up because we're getting right to the peak of our at the money bell curve. We were over here in this range, slightly in the money. We were over here this far as much in the money, where the extrinsic or time value is less. Now we're at its peak right here, and we were also at 714 when we had the highest extrinsic value on the position. And then moving forward, what do you see? Exactly what you'd expect. The stock starts to waffle around 226 and 224. The price is increasing, but then we get that nice jump for a profit up to 173. Then it pulls back down a little bit back to 235. But you see the price is just going to zero because it stays above the short put strike price at that time. Why did I go through all this? Well, it's because to illustrate to Salvatore that you're not just looking at expectation. If I'm in a naked put position, the stock starts to fall. It's not just the intrinsic value that's hurting me. As I'm getting closer and closer to the at the money strike price, we're going to see a flux of the extrinsic value to a higher range, which is going to increase my buyback cost. Time value is always decaying, but also as you're going around this ATM bell curve, the stock's moving around these prices here, you're going to see a swelling of that extrinsic value, the value that is not the amount you are in the money in that case. And if the stock, again, did stay right where it was at this point at 229.94, if it stayed there for the next 16 days, you would have seen this 1060 extrinsic value just decay on that standard time decay curve to where you got down to zero at that price, or it would have gone to 6 cents, the remaining intrinsic value, to buy it back. So Salvatore, this was sort of a wild ride, and it illustrated all of the different points you mentioned. What is one thing that's missing from this discussion? During this time period, another factor that would have come into play on this extrinsic value would have been implied volatility. The stock is, we don't want to call it crashing, but it's dropped 20 points, 23, 24 points. Almost 10% over a 3 or 4 day period. That's going to cause a lot of fear in the market. That's going to cause the implied volatility of this option and the options around it to increase, which is going to enhance the extrinsic value as well. In addition to getting at the high point of the ATM bell curve, you're also seeing implied volatility increase, which is also inflating the prices of these options at that time. Shifts in implied volatility, the stock bouncing around your strike price, going from at the money to in the money to out of the money. Yes, when it was the deepest in the money, that's when we saw the highest buyback cost, but most of that was the intrinsic value of 10 points. Okay, 939, excuse me, in that case. So This, though, did show us just about everything you're asking, Salvatore, from where we went to be at the money prior to expiration as time was passing, deep in the money prior to expiration as time was passing, again to back out of the money, and how we'd expect the option to react. I mean, gave up 7 points right there from 895 when it was at 224. It was 7 days to go to expiration, 225 again, let's call it. So only 395 was time value or extrinsic value at that point. And then that big jump up to 245, it went down to 173. Pulled back 10 points, was at 295 in that case. It's going to fluctuate. What's going to cause the fluctuation? The price movement, yes. Changes in implied volatility, yes. And waffling around the ATM bell curve as your options going to at the money, then slightly more in the money, then out of the money, then maybe back to at the money. You're going to see that extrinsic value swell when the stock is closest to the strike prices here. And this is a great illustration. Anytime you have questions about how would my options react, how would this react over time, use the historical tools to find a similar structure and a similar trade to what you're evaluating. And then you can see how that one performed over time using either the analyzed position view or using the price history here. So you can see it over time with the stock price compared to the option price as well. So Salvatore says, thank you so much, Michael. Great example. And it's a great teaching tool and how powerful PowerOptions really is and how much there is to learn and explore. Yeah, so you want to take a look at that. Whenever you have questions about how would this option react, how would I expect it to react, use the Black-Scholes calculator to see your current options. But if you have the historical tools, you can jump back, find a similar example. Something that I looked at for Salvatore was something that was 8 or 9% in the money. I'm sorry. 8 or 9% in the money, 8 or 9% out of the money, Mike, get it right, with a premium of around $10 to $13 back 2 or 3 months. And I saw that opportunity there with the Coinbase position of how the option would react. But it's not just one thing. It is the stock price change. It's also changes in implied volatility, and it's also the bouncing around the ATM bell curve. As you get closer to your put strike price, you're going to see an influx of extrinsic value. Also, with this example, would have seen an increase in implied volatility over those first 5 days, then maybe an easing off as we got to the last 10 days and the stock began to recover.